Alright, so today I wanted to make a video on every single stock that I'm currently buying. I would stress there is some that are on a watch list that, again, if they come up with bad earnings or something and it goes down 10 or 15%, I probably would pick up. There is a lot of those, but these are ones that I am currently dollar cost averaging. So again, I'm going to talk briefly. I'm not going to go into any detail because most of them I've already talked about before, and it would take forever if I went into all of them. So the first one here is ARLP. Again, this is an oil and gas play. I like them mainly because, again, they got a very high earnings yield. Again, almost 21%. They're paying a 12% dividend. Again, they are actually very close to their 52-week high, I think. Actually, it's about 24, but that was quite a while ago. That was back in October. So again, this is just basically dependent on oil prices. If oil breaks to a new high, I probably would stop buying these. Also, this is a master limited partnership, it looks like, as well. So that's another thing to keep in mind. The next one is PLAB. Again, this is one I've never talked about before. Again, a smaller cap name. And this is honestly, it's kind of a speculative play because it trades really cheap, but it's always traded really cheap, at least for a semiconductor name. Again, a price of free cash flow of 11, a PE of 13. So again, like I said, it is a little bit of a speculative play, but I mean, from what I can tell, it looks pretty good where it's at right now. It's growing well. It is, I mean, a current ratio of 4.3. So I'm going to take a chance on something like this. Again, some of these are speculative plays, and this definitely falls into that. I mean, small cap companies in the first place are usually kind of speculative, and when it's a semiconductor name, yeah, it's definitely a high risk, high reward play. So keep that in mind. URA, again, this is just a uranium ETF. This is one that it's done very well over the last year. I've been buying this for quite a while. I mean, I first bought this at like $20 a share, $19 a share. So I have a pretty decent position in it already. I'm going to keep buying this until it gets up to 3, 4, maybe even 5% of my overall portfolio. And again, I'm still maybe halfway there. So again, unless this gets really expensive, which I don't even think it is where it's at right now, I'm going to keep buying it because I think uranium is to some degree speculative, but on the other hand, the reward or the potential reward is just so high that I think that this is just a no-brainer. The next one is going to be Skyworks. Again, this one's came down recently because of slightly weaker than expected earnings, but I still like it. I still think it's a really good company. I mean, not to mention, too, the dividend yield's almost 3%. I mean, they're growing that 10, 12% per year. So I still really like it. I think it's going to be fine over the long run. The next one is NSSC, NAPCO Security. Again, this one I think is fairly speculative as well. Again, a smaller, maybe even, smaller cap name. I mean, where it's at right now, it looks really, really promising. But again, I don't think it's going to continue to put up these kind of numbers. And it still is arguably expensive. It's significantly below its historical valuations, but I mean, a price of free cash flow of 42, a PE of 38, that is still expensive. So if I'm being frank, I think I started buying this around $40 a share or so. I mean, if it went, I mean, the 52-week high is 46.41. If it hit that, I definitely would stop buying. In fact, I might already stop buying. Because again, I did start buying it, I think around 38 or so. I know it was in the 30s when I first started buying. So this one definitely is expensive where it's at right now. The next one is BAM, Brookfield Asset Management. Again, I like them because they're a dividend growth name, and again, I think the parent company is very solid as well. But I mean, look at this dividend growth here. I mean, 42% over the last 3 years. That's phenomenal. Like, that's absolutely phenomenal. And not to mention too, you have a 3.8% yield. If they can grow it even 15% per year on a 3.8% yield, that means that they're basically doubling it every 4 years, right? So you're going to have a 7.5%, 8% yield in 4 years, and you're going to have a 14% yield in 8 years. You're going to have probably 17, 18 in 10. Again, that might be a little bit aggressive, but I think that if you hold this for 10 years, you're going to have a yield that's in the double digits. So, and to me, that's just a no-brainer. So that's why I own them. The next one is CEIX. Again, this is kind of they're in the coal business, and I think they're in oil and gas as well. Again, this one has very good numbers where it's at right now. And I mean, a 27 free cash flow yield, a 26% earnings yield, that's pretty hard to pass up, in my opinion. And not to mention, they got a 5% dividend yield. I mean, the payout. Imagine a company that has a 5% dividend yield where the payout ratio is not even 20%. So again, this one definitely is a little bit speculative, but I still think it's worth the risk. I mean, the industry that it's in, I think it's still going to do okay. I still think it's going to do okay. And again, they're a $2.5 billion company. So again, definitely fairly risky here. A lot of these companies are risky because a lot of my more stable companies I already have full positions in. This one, again, definitely risky, but I think it's another one where I think it's worth the reward. And I mean, look at how high it's gotten just over the last year. I mean, $114 a share is the 52-week high, and it's still at 86 with prices where it's at. Let's just look at its valuation, just out of curiosity here. Again, a PE of below 4. The 5-year average is 36, but I mean, I wouldn't be paying anywhere close to that. So I still think that it's, if anything, it's cheap where it's at right now. So. And I mean, not to mention too, they're look at how many shares they bought back 11% of their shares last year. Let's check that out just out of curiosity here. Again, so they were at 35 million. They're down to about 33, but I mean, they are still up over the last 5 years and 10 years. So I mean, that's a little concerning. But I mean, with the free cash flow yield where it's at right now, they had better be buying back shares and paying down debt, which again, their balance sheet does look pretty good. Again, liabilities, I guess the liabilities 1.3 on a $2.5 billion market cap. That's arguably concerning, but I mean, the assets to liabilities here is still pretty good. And if we look at their liabilities, again, they are indeed paying that down very nicely. In fact, it's basically been cut in half ever since the high from 2017. So I like that. I like this company. I'm going to keep buying it until it's probably in the 90s, maybe even $100 a share. So, and it could go there like in a day. So keep that in mind too. The next one here is ODFL. This one again is arguably expensive where it's at right now, but I think this is a phenomenal company. If we look at its valuation, again, price to free cash flow of 48, that's expensive, but a PE of 31, that's basically right on its historical average. Again, this one definitely is expensive. I mean, if it went above 190, I for sure would stop buying. I would definitely be more aggressive if it went like 10-15% down where it's at right here. I am definitely dipping my toes in here. I'm not buying aggressively, but again, if it went like 160, if it went into the 160s, for sure 150s, I would be a lot more aggressive, because I think this is a phenomenal company right here, and in an area that does not get a lot of hype, but it should be getting a lot of hype. Again, look at its dividend growth rate, 35% over the last 5 years, and not to mention the payout ratio is 27% based on free cash flow. So they're going to keep growing that very, very nicely. The next one is Primerica. Again, another company I've talked about before. I really like them. Again, I think that insurance is going to be an area that's going to do very good, especially with higher rates. That's money that's going directly into the pockets of insurance companies, because they have to invest a lot of their premiums in safe, or quote unquote safe assets like T-bills. So again, with higher rates, a company like this is going to do well. Again, a PE of 13, to me, that's a bargain for a company that's beating the S&P, I believe. Let's check and see here. Actually, it's easily beat the S&P over the last decade. I mean, it's almost doubled it. If we look at it compared to the last 5 years, we're looking at maybe almost exactly the same. So, I mean, if you can pay a below market multiple for a company that I think is going to, at the very least, keep up, probably beat it by a little bit, to me, that's a no-brainer. I mean, they're growing that dividend 20% per year. I mean, 16 over the last 3 years. Payout ratio is below 20%. Free cash flow yield of 8.6%. To me, that's just another no-brainer. Again, I think they're buying back shares as well. Yes, they actually look at their share buyback here. I mean, going back to 2014, they had 54.6 million shares outstanding. Now they're at 36 million. I mean, that's got to be what, 3% per year roughly they're buying back, which is phenomenal. I mean, look at their growth here, like just amazing growth. I mean, obviously they got hit hard in 08, but I mean, ever since 2011, they basically 3x their premiums, which is pretty good for an insurance company, I'd say. So again, Primerica, I would be buying probably until 230, maybe even 240. So I really like it where it's at right now. The next one is Masco. Again, this is one I made a video about very recently, so I won't get into much at all. But again, in a very good area, 7%, a very good industry. 7% free cash flow yield. Again, I really like that. Again, a lot of room to grow there. Again, they're growing their dividend very nice. I really like this company. So again, check out the video that I made recently if you want more info. The next one is ACLS. Again, another little bit more speculative play here. This one I like mainly because it's basically at a 52-week low. I mean, the 52-week low looks like it's a little bit lower than where it's at right now. It has bottomed out of that fairly nicely. It looks like about $94 a share roughly. It's back up to $111. But when it was right around this area, this is when I first started buying it because I had a 52-week low notification on for this company, and when I seen that, I started buying. So I'm actually up fairly nicely, although the problem is that it's an extremely small position based on percentage. But again, if we look at its valuation here, again, it is still, if we look at PE, it's at a 14.6 based on free cash flow, 27. I think that it's probably still maybe a tiny bit undervalued where it's at right now. I mean, it's growing nicely. It's got a current ratio of 4, which is extremely good. Again, management's doing a good job. Profitability is very good. Again, I think probably just bird's eye view here, I would probably still be buying until like 120 a share, probably maybe even 125, 130. I'd have to dig a little bit deeper, but I mean, this company's been as high as $200 a share this year, just in the summer. So again, I still like it, and I mean, it's a smaller cap name, I guess maybe mid cap, depending on what you consider mid cap, but I still like it. I still think it has a lot of potential, and that's why I'm buying it. The next one is ALLE, which again, I literally just put a video out about a week ago, so I'm not really going to get into it, but another solid company in a good area that I like. So again, that's why I'm buying it there. The next one is EOG, which is probably my favorite oil and gas name. In fact, it is my favorite oil and gas name. Again, it's performed extremely well. Again, dividend growth is very good. I mean, this is one of the few companies that even through the 2014 downturn and the 2020 downturn never cut their dividend, which again, I really like. That's one of the main reasons I'm buying. And I mean, the payout ratio is still 28%. So again, they've grown it 22% a year over the last decade. I think they're still probably going to be able to keep doing that. And I mean, oil prices are pretty high right now, but again, it's got a PE of 10. I mean, I still think that I would definitely still be buying this company. Again, it is going to be dependent on oil and gas prices. If we see a recession, oil companies are going to get hit hard, which honestly, in my opinion, would just provide a good buying opportunity. So keep that in mind. The next one is Carlisle Companies. Again, I've talked about before. I do like this company. Again, in that building area. Another area that I think is still not necessarily overvalued. Again, price of free cash flow of 5.5. Again, this industry, there definitely is some companies that are overvalued, but I think it's a really good industry. And I think if I'm looking at all the sectors right now, I think that industrials might be the most underrated sector because there's a lot of really good names in that industry. And we are seeing a lot of growth to the population in North America. And a lot of population growth means we're going to need a lot of building to get done. And I think a company like this is going to do well. The next one is AMAT. Again, I've also made a video about this maybe a month or two ago. Again, one of the larger cap semiconductor names, but again, I really like it. If we look at its valuation right now, it is above its historical averages, but again, a 22 price to free cash flow, a 24 PE, I don't think that's necessarily super unreasonable. It definitely is arguably expensive where it's at right now, but I don't think it's atrocious by any means. And I mean, they're growing their dividend extremely well, which is really what I like to see. So they've always massively outperformed the S&P. So again, if I can pay, a 22 price of free cash flow, it's definitely above a market multiple, but for the semiconductor industry, 22 price of free cash flow probably is below a market multiple, and I think this company is going to keep up with that industry, and I think you're paying a little bit less. So that's why I like it. The next one is Caterpillar. Again, same story with Carlisle. Again, we're going to have to do a lot of building, and this one, honestly, to some degree, is a stability play. I think that this is just a no-brainer for the next 10, 20 years. Does anyone really think that this company's not going to see solid growth? Again, you're not going to destroy the market by any means, but you got a 6% free cash flow yield, 1.5% dividend. They're going to grow that 8% per year, like clockwork. It looks like payout ratio is 22%. They beat the S&P. So, again, just another no-brainer in my opinion. If we look at its valuation here, again, just below 15 PE. That's below the market for a company that I think is safe for stock standards, and is going to, I would say, probably beat the market. If anything, if you can pay a below market multiple for something that's going to do as good or maybe even a little bit better than the market, again, to me, that's just a no-brainer. So that's why I'm buying that. The next one is CDW. Again, this is a stock I talked about very recently, so I'm not going to get into. Again, I like it for many reasons. Dividend growth, they're buying back shares, they're in a very good industry. That's why I like it. Again, free cash flow yield of 5%. Again, what is there not to like here? The next one is Accenture. Again, another company that I think is going to do very good over the long term and has a lot of tailwinds. And that's why I like it. Again, they're down significantly from their 52-week high, which again, in my opinion, just provides a good buying opportunity. They've got a 4.5% free cash flow yield. If we look at its valuation, it is below all of them, although it is above what the market is. But again, I think that this is an area that we need. Businesses need. We don't necessarily need it, but businesses need it, and they're one of the best of the best in that industry. So again, that's why I like them. They've always performed very good. They're growing their dividend very nicely. The payout ratio is below 50%. They've historically beat the market. So again, that's why I'm a fan there. The next one is Valero. Again, and this is probably my third or fourth favorite oil name. Again, they've always done well. Again, another company that's consistently grown its dividend. The payout ratio is still very low. That's why I like it. And not to mention, I think they're buying back shares very aggressively, which is what I like to see. Yes, they've bought back a significant amount of shares. So that's what I like there. Again, another very solid company. The next one is BLD. Again, another one of those industrial names. This one, if we look at its valuation, again, below, PE of 20, price of free cash flow of 16 for a company that I think is going to keep pace with the market. If anything, they might beat the market. So that's why I like it a lot there. Again, 6.2% free cash flow yield. What is there not to like? And the last one is MSCI. And again, they released bad earnings recently, and that's when I first started buying. I think it was in the 440s. They are back up. This one, again, you got to be careful because it's bordering on expensive where it's at right now. But it is significantly below its historical averages. But that is expensive. Again, if this company went above 480, 490, I would stop buying. But they're growing very well. The management does a good job. Profitability is through the roof. This is the main reason you're buying a company like this, is the profitability is absolutely very good. So that's why I'm buying MSCI. So again, that is every single company that I am dollar cost averaging right now. Again, love to hear thoughts, feedback, all that good stuff. And stay tuned for next video.